This morning, inflation did a sharp U-turn. Check out the producer price index numbers, which were forecasted to come in at 2.5% year over year. They actually came in higher than expected at 3.3%. Inflation, a little bit hot here. And while earlier this week, we got a cooler than expected CPI headline data point, core CPI came in 3.1% year over year, which was higher than the expected 3%. And let's do a recap of our inflation reports this week. So as I mentioned, CPI came in a little bit lighter than expected, but the producer price index came in much higher than expected. This morning we did also get, however, some slightly better than expected initial jobless claims. The dollar moved higher off of this, as you might expect, because again, sticky inflation could mean the Fed may be less likely to cut interest rates. And while yesterday we were expecting about a 99% probability of a rate cut in September, the upcoming meeting, we're now looking at the bond market suggesting about a 92.5% chance. Now, none of these numbers are guaranteed or locked in forever. As you can see, we went again in one day, we dropped by 6-7 percentage probability points. But still, the large expectation is that we're going to get a rate cut in the upcoming meeting. And when we look out to December of this year, the probabilities are still largely in favor of 2 to 3 rate cuts of 25 basis points or 0.25% each time. So the expectation is that we're going to get a total rate cut of about 0.5 to 0.75% cut off of the Fed's target rate, which should act to ease some of the borrowing costs for home buyers, for small businesses, for consumers at large. Here's a look at the stock market's reaction. We did see an initial drop here, clearly showing that investors and traders alike do not like to hear about higher inflation. However, you can see that the market has rebounded pretty sharply, as this is a market right now that seems to buy every single dip and just kind of chug along higher because of the bigger overall narrative, which is the Trump administration seems to want to do more for businesses to keep them growing. At the same time, we're probably still going to get rate cuts, and corporate earnings are running really hot. So companies are doing really well, and overall, the market kind of continues to chug along higher because there's not some sort of big obvious thing right now that's going to scare the market into moving lower. I think that's very well reflected in the volatility index, which back in April, when everybody was worried about what tariffs were going to do to the economy, that was causing a huge amount of volatility. The stock market was dropping, it felt like every day. And then all of a sudden, essentially deals started to get made and pauses were announced on all the tariff concerns. And we've really seen all of that fear completely deflate out of the market. Now, you might be arguing, or you might be thinking, well, I think the market is a little too comfortable. And I would actually agree. I've been pointing out in my videos and streams that when it comes to the stock market, while I'm not willing to try and make the call that, some disaster is about to happen, I can't make that timing prediction. But what I can say is that I think that the market overall is a little too complacent and a little bit too satisfied and doesn't see any sort of risk coming down the pipeline. And I think that's exactly when you can get yourself into trouble and all of a sudden see a 5 to 10% pullback in the stock market. It's a very healthy thing and a very normal thing for stock markets to pull back even in bull markets. We've seen that for the better half of the last 5 years or so, where we've been in predominantly a bull market with these multi-month kind of downtrends in between the overall big picture uptrend. But not all indices are created equal. Take a look at the Russell 2000, which is the small cap index. This is a basket of 2,000 smaller companies in the United States. Still good sized businesses, but not nearly as big as your Apples and Amazons. Well, this index is actually lower today because this one is more sensitive to interest rates because smaller companies require more borrowing in order to continue to grow. Whereas an Apple or an Amazon, which are sitting on mountains of cash, do not necessarily need to borrow money to continue to thrive. I think those bigger companies have done really well in recent years because they don't need to borrow money. But smaller companies have struggled on a relative basis to the large cap stuff because they do need to borrow. So in my opinion here, I think that if we start to see an environment where rate cuts do start to kind of become the new norm, you may get some relative outperformance on the Russell. So I've been saying that for a while, so I'm definitely not, perfect in timing this, but I do think that there are some upside gains to be had on the Russell. And if there are, a push lower in small caps, I may look to get back into a trade that was a really good one for me for a good chunk of this year. I pretty much captured this whole leg of the move here on an active trade. So I may look to get in to see if I can catch another wave high. higher. However, currently our impact chart here on the EdgeFinder is a little bit mixed for stocks, and with stocks near their all-time highs, I'm just a little bit cautious to try and get overly bullish or bearish on the market. But we can definitely see something interesting happening in the institutional data that we track within the EdgeFinder. Check this out. The overall exposure to short positions for the dollar is increasing from institutions continuously shorting the dollar. Take a look at this yellow line, which represents long percentage of contracts traded by institutions over time. What we can see is this chart is moving lower. That's telling you that institutions are more and more bearish on the dollar index. And I think that that can go on for a while. Clearly, it has been a trend for most of this year. Institutions have been shorting the dollar and probably cashing in big on this. When we take a look at the dollar, I'm definitely a little bit more poised to be on the bearish side of the dollar, at least at this time. For example, a pullback in the euro dollar looks attractive to me on the long side, perhaps around the 1.16 or 1.145 area. And gold on a pullback looks really attractive to me with a plus 12 score on the EdgeFinder. This definitely leans very bullish at this time. However, from a technical basis, gold still looks like a disaster, just a choppy mess. If we do get a push down towards the bottom end of this range, I may look to buy some gold, or if we see a breakout and retest, I may look to buy there. I've talked about this a lot here recently, so I don't want to beat this topic over and over. I've said it, many times on my channel, but gold is really choppy. I'm waiting for a more decisive price action move rather than messing around trying to buy it or sell it within the chop. Really, to me, I have no interest in doing that. I'd be interested at the lows or at a break and retest through the highs. Both of those look like opportunities to me, but before that happens, no interest in trading it. Silver, however, is also getting a bullish reading. Let's check this out. If price comes down to the 36.5 level, I'm definitely interested in watching silver as well. It actually has been trending nicer than gold in recent times and looks relatively attractive if you do get a drop down into this area. By the way, the tool that I'm using is called the EdgeFinder. If you're newer to my videos, we're doing a giveaway of the EdgeFinder this week. It's the tool that I use to scan a ton of market data and to help me find the trades that I take. Pretty much it does a lot of the heavy lifting for me. It tracks sentiment data like the commitment of traders data to track institutions, the technical screenings that it does on momentum and different price action, as well as the economic data scores that it does, which is essentially it looks at all the inflation measurements, growth metrics, and of course job statistics that we have imported into the tool. It's all automated and generating a report card each day, which essentially gives me a watch list that I can come back to each and every day, as I do in a lot of my videos. So if you don't have a copy of the EdgeFinder, I've got two things for you. First of all, we're doing a giveaway this week in our free to join Telegram channel. We'll be announcing the winner tomorrow, but all you have to do in order for a chance to win a free copy, and this is lifetime access to the tool, for a chance to win, all you have to do is step 1, join our Telegram channel, which is linked in the description down below. And step 2, just fill out this form that is in the Telegram channel right here, the EdgeFinder giveaway form, and you may be the lucky winner. Again, it's free to join. We also share a ton of great free chart markups and things that we're watching in the market. So our team does a pretty good job just putting together research and content that we found. So if that seems helpful to you, you might as well join the Telegram channel anyways. And if you're watching on a television or a computer and you don't want to click links or go through the process, you can also scan this on your phone if you have Telegram on your phone. I know this is kind of cool. I don't know if a lot of people use QR codes or not, but my team put this together. So if you want to join the Telegram and use a QR code, there you go. And the stock market still rips higher here today, even though you get some hot inflation prints. What's going on? Well, right now there is still frenzy buying going on in this market. Take a look at the put to call ratio tool that we have within the EdgeFinder, which shows you options volumes on the S&P 500, or by the way, you can select a whole bunch of stuff. So if you want to track options volume on gold, the NASDAQ, Nikkei, this gives you a really powerful tool to track what the crowd is thinking. And what the crowd is thinking right now is the stock market's going to rip higher. And so what do we do with that information? Well, to me, it's contrarian. When I see everybody getting long the stock market and everybody's going out and parading and hey, the stock market's going to go through the roof, I get really cautious and have no interest in buying alongside the crowd. So for me, I see this as, okay, this is a warning sign that, okay, everybody's kind of getting pumped into the stock market right now at the all-time highs. To me, that suggests, okay, we may be getting a little overbought and due for a correction. Doesn't mean we have to have some sort of market crash or that I'm calling for that. I just think that you have a little bit of stretched price action that we're due for at the very least a couple days down, but perhaps a move down to like 6,200 or 6,100 in coming weeks makes a lot of sense to me. Again, not something I'm willing to short the market on. Like, this is not a reason for me to short. In fact, I think the indices generally are getting more bullish readings within the EdgeFinder. But with this information, I'm definitely just going to sit on the sidelines, sit on my hands and wait for pullbacks rather than try and short this market. We're also seeing yesterday a huge surge in call demand for the Russell 2000 index, which just so happens to be getting hit the hardest today. As I mentioned earlier, the Russell's moving lower in reaction to today's inflation print. And it goes to show, like I said earlier, that the indices are not created equal. There are certain areas of the market that are way more or way less sensitive to what's happening with interest rates. Here's a look at the German DAX. Looks really strong here and pushing back towards the all-time highs. The DAX is a bullish rating on the EdgeFinder and actually quite interesting to me if we were to get a breakout through the highs or a retest of the bottom end. I know I've said this many times on many charts, but I'm looking for breakouts because we've been in such a low volatility environment. Things have just kind of been chopping a lot. And so I'm waiting for a breakout here on this one. Bitcoin was down 3.7%, while Ethereum only down 2%. Some relative outperformance by this melt up that we're seeing in Ethereum right now. Bitcoin retesting this area of 120,000, this area of support. Not currently getting a bullish or bearish reading on the EdgeFinder, but if it does pop in there, the Bitcoin setup looks really interesting to me for kind of a continuation if I wanted to take a small bet that I think that the risk on rally can continue. And again, I'm not really willing to try and call the top on stocks or risk on assets. I just think that they are a little bit overstretched. And so if I were to take a trade on Bitcoin, for example, which I'm not because I don't have my top setups indication that I would like to buy that. But if I did, it would be a really small trade with a tight stop. Today's video is sponsored by a long-term friend of the channel, Audacity Capital. Audacity Capital offers instant funding or two-step evaluation offers for people who are looking to get funded. They offer up to a 90% profit share, and now they're offering DX Trade, which is another popular trading platform. And they've been in the game since 2012. That means they were established 13 years ago, which is longer than I've been trading. And an exciting announcement is that Audacity Capital is back for US traders. If you are looking to trade with Audacity Capital, check them out, see if they're right for you. Make sure to use your due diligence. And for a limited time, the promo code TraderNick10 will get you 10% off their ability challenge. So check out Audacity Capital. We'll leave a link in the description down below, and don't forget to use that promo code for 10% off. Now back to the video. Right, let's do some beginner friendly stuff. If you're newer to economic data and how it impacts the markets, let me ask you guys in the chat, if you get higher inflation like we did today, the producer price index, a reading that measures inflation, year over year came in hot. Also, did Othman share 2.5% was the forecast? Got it. Okay, so we came in way hot with inflation this morning. Let me ask you guys, interest rates. Does that mean that interest rates are more likely to be cut or less likely to be cut? Right, so we're all talking about, oh, when are we going to get rate cuts from the Fed? If you get inflation rising, how does that impact interest rates? Does it cause interest rates to get cut sooner or not so much? Are rate cuts more likely or less likely? It's a good quiz for the aspiring macro traders or the fundamental traders in the room. And sometimes, guys, this stuff is not that hard. It's really sometimes, you look at the Russell is dominated by interest rate sensitivity. Look at this thing, 1.5%. I mean, it was up 3% the other day. So this thing moves so violently. It has more implied volatility. If you're an options person, it has more implied volatility than the NASDAQ. It has more implied volatility than the S&P 500. Another little side note, not sure if you guys knew this or not, fun little side note. If you're somebody who trades metals, did you know that gold has much less implied volatility than silver? Silver moves more than gold. On both a historical volatility and an implied volatility, gold moves less than silver. Anyways, I see a lot of people with the right answer. The answer is less likely. So if inflation is hot, interest rates will likely not get cut as much. Now, we're still almost certainly going to get an interest rate cut in September. But the question becomes not about September. September, okay, we're going to probably get a cut. We've had a good bit of progress in inflation overall. Maybe today's number is not super supportive of that, but it's been a lot better than where we were a year or 2 years ago, right? But if we're talking interest rates, we also have to think about, okay, they have a meeting in November, they have a meeting in December. Are they going to cut again? Are they going to cut 2 times, 3 times this year? You know, they cut by 0.25% standard each time when they do cut interest rates. But right now, yesterday, the market was thinking 2 to 3 rate cuts by the end of the year. Today's number may suggest more likely we're just going to get 2 rate cuts. That changes the calculus around the Russell. It changes the calculus around stocks, changes the calculus around gold. That's how this stuff is impacting all of our charts. I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.